In early 2021, a dying mall video game store became the most talked about stock on the planet. GameStop traded around $17 at the start of January. 3 weeks later, it touched $483. The company hadn't fixed its business. It hadn't launched anything. So what actually happened? The answer comes down to one number most investors never look at: the float. And once you understand it, every meme stock explosion since starts to make sense. Start with the basics. When people talk about how many shares a company has, they usually mean shares outstanding, every share that exists. But not all of those shares are actually available to buy and sell. Founders, executives, and big institutions hold large blocks they aren't trading day to day. Strip those locked up shares out, and what's left, the shares actually circulating in the open market, is the float. The float is the real supply. It's how many shares are genuinely available for the rest of us to trade. Here's why that number matters so much. A stock's price is just supply and demand. When the supply of tradable shares is small, it doesn't take much buying to move the price hard because there simply aren't many shares to go around. A small float is a small room. A few loud buyers can fill it fast. A massive float is a stadium where the same buyers barely register. Now add the other ingredient. Some traders bet against a stock by short selling. They borrow shares, sell them immediately, and plan to buy them back later at a lower price, pocketing the difference. It works great when the stock falls. But it carries a unique danger. If the stock goes up instead, the short seller is now losing money, and the only way to stop the bleeding is to buy the stock back. To exit a short, you have to buy. The key gauge here is short interest as a percentage of float. How many of those floating shares have been borrowed and sold short? Most stocks sit in the low single digits. Once it climbs past 10%, traders start paying attention. Past 20%, it's a crowded, nervous trade. And here's the strange part. Through relending, a single share can be borrowed and shorted more than once, so that figure can technically climb above 100% of the float. Stack short selling on top of a thin float, and you get a short squeeze. A heavily shorted stock catches a spark, some news, a viral post, a buying wave. The price ticks up. Short sellers start losing money, and some rush to cover by buying back shares. But that buying pushes the price higher, which forces more shorts to cover, which pushes it higher still. Add margin calls. Brokers demanding the losing shorts put up more cash or get bought out automatically. And you've got a feedback loop. Each forced buy becomes fuel for the next. This is where the float closes the circle. In a stock with a small float and heavy short interest, all those panicked buyers are fighting over a tiny pool of available shares. The squeeze isn't just likely, it's violent, because the supply is so thin. Small float, big short interest, that's the powder keg. Which is exactly what happened to GameStop. By late January 2021, short interest had reached roughly 140% of the float. More shares sold short than were freely available to trade. The Reddit crowd poured in, the shorts got trapped, and a $17 stock ran toward $500 in a matter of days. Not because the business changed, because the math did. And that's why this keeps happening. When a beaten-down name with a small float and a pile of short bets catches fire, a fast food chain in 2026 was just the latest. You don't need a Reddit account to see it coming. You just need to know where to look. The float tells you how big the powder keg is. Short interest tells you how much powder is packed in. The explosion is just supply and demand, turned all the way up. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.